Welcome to TheoTrade. This is Don Kaufman. Here we are. It is November 3rd, 2017, doing the Theo weekend video here on a Friday afternoon. Let's start with a little bit of the bigger picture here in the S&Ps, work over to the Nasdaq, and really a couple of standouts this week. Of course, one being none other than Apple. So let's get right to it. The week saw the S&Ps tracking very, very slightly to the upside. You know, if you turn on some of the media out there, they'll get you to believe it's a massive rally to the upside. But to put a little perspective in play over here, I'm going to cruise over to the SPX. And as you guys know, each and every week, I track what are termed expected moves. And these expected moves, this is where it's at right now. And what I mean by that is the option markets are really dictating the movement inside of the, not only the SPX, which of course that's the option market, but the SPX option market is dictating how far the futures can move kind of in a week in and week out basis. And one of the things, again, to just give you a little bit of a perspective of where we ended last week. Again, last week we ended just shy of 2580, and well, we finished the week in the SPX. Okay, and that was the high over there was 2588, but we finished the week in the SPX at 2587. So when you're looking at the idea, it's a massive rally of what? It's a handful of points. The SPX was expecting about a $22 move, and we stayed well within that range. Now, before I even go any further, the coming week, you can see I've already kind of put up the expected move, and this coming week is even a more shallow expected move. Again, the previous week's move was about $22. This coming week is within the $21 range. Again, it's actually one of the lowest expected moves that we have recorded in, of course, a non-holiday week. Again, we're looking at about a $21.30 expected move, which is pretty incredible. I mean, looking at Monday's expiration, you have 4.9% volatility. I mean, that's like the same thing as seeing if you saw the VIX at 4.9%. Obviously, the VIX is low enough, right? The VIX is over here, and again, you'll follow along on my screen. The VIX as it is at the 9 handle, the 3-day VIX, if you will, and this is a VIX that literally would expire, of course, on Monday. It's at 4.9%, which is it's staggeringly low volatility. Now, again, looking, back, looking forward over here, and we're kind of giving you perspectives both ways. Again, the move that we saw this last week is fairly minimal. The move that we're expecting in the next week is fairly minimal. Now, the next point I want to make is kind of a strange one, at least for me. For those of you that kind of stay tuned in and turned on, if you're trading a little bit more actively, you might have picked up on this. If you're just somebody that's, tuning in, you're a bit more of an investor, you just like to tune in on the weekend updates, fantastic. But let me show you something that's, number one, strange, number two, incredibly, I think it's alarming to me more than anything, and that's this. So I'm going to go to the S&P futures to kind of display this. This week, we saw all kinds of news events this week. And I've kind of been, out there dictating again and again that news no longer is in play in the markets. And I'm going to show you a little bit of evidence of this. So this morning was the jobs report. You're like, well, what's the jobs report? It's the jobs report. The employment situation came out this morning. That employment situation, it came out specifically at 5:30 Pacific time. Okay, so 5:30 Pacific time, report comes out. You got to recognize that we only did 2,000 contracts in the S&P futures. I mean, it just pointed out, yeah, maybe 2-3 minutes later, oh, well, we picked up there to 4,000 contracts. But the point I'm trying to make with this, all right, so the jobs report, I get it, Don, the jobs report, it missed. They were expecting over 300,000 jobs. This wasn't hurricane wasn't going to be, impacting it nearly as much. Anyway, the jobs missed. It hit 261, but it doesn't matter. And that's the point I'm making with this. But I'm going to further that point. You know what does matter? Apple. Okay, there was more action, all right, in the S&P futures when Apple's earnings came out. Now, here's again Apple's earnings, and when you see Apple's earnings coming out, this actually drove not only, and we'll come back to the S&P futures though here in just a moment, but it drove the Nasdaq futures, okay, completely nuts at this point in time. So I want you to think about this for just a moment. And I'm showing the Nasdaq futures because the Nasdaq future was this, well, I mean, it was really drastic. It was extended just to show you the marketplace right now is paying attention to one individual firms. Now, granted, they're the largest market cap out there, right? I'm sorry, they're a $900 billion company. But since when is one firm's earning report, okay, moving markets more than the employment situation of the entire U.S.? Moreover, I can also make the argument that Apple's earnings report actually moved markets than the announcement from the FOMC. I'll even take it a step further. Apple's earnings report moved the markets more, okay, than the naming, okay, of Powell to now run the FOMC. It's shocking from a perspective of a trader. And I've been doing this, almost 20 years, and I've seen some pretty crazy things out there. But when you have one company, Apple, and I'm picking on Apple because, well, it had its earnings, but you could say the exact same thing about Amazon. So we are into these monsters of tech, and I call them the monsters of tech. And what do I call the monsters of tech? It's Facebook, Apple, Microsoft, Google, Amazon. And if you take a look at the monsters of tech this week, you'll notice, again, an explosion to the upside. Again, all I'm looking at here is I've actually combined all 5 symbols. And I talk about this quite frequently here at TheoTrade. I kind of built our own index. We took, 5.8 times Facebook, plus 6.4 times Apple, plus 12.7 times Microsoft, plus Google, plus Amazon. And what I did is ultimately made each one of these, okay, right about a $1,000 product. So for the most part, I equated them to about a $1,000 product because at the time I did this, both Google and Amazon were right around $1,000. It's kind of an equally weighted index, if you will. Well, that index is exploding to the upside. In fact, if you look at the year-to-date percentage return, those 5 stocks have accounted for about 42% return year-to-date. Again, on kind of an equal weighted basis, about 42% return year-to-date. But if you go take a look at the Nasdaq's only up about 28%, which brings me to another very, very interesting point. Whether you're looking at the S&Ps, whether you're looking at the Nasdaq, it really stands out when you see a day where the markets rallied, like today. I mean, the S&Ps were only up 450, but they still rallied 450. And the advanced decline line, okay, is a 50-50 shot out there. And this is the influence, again, of these they're mega market caps. A $900 billion company becomes worth more than the vast number of other products in the index. And that's specific to the Nasdaq. But if you look at Apple alone, okay, what it's worth, okay, versus the other products in the entire Nasdaq over there, again, you buy half the Nasdaq for what Apple is worth at a $900 billion market cap. And this is when we're starting to get distortions on a day-to-day basis where we have a 50-50 advanced decline line in the S&P, okay, but the S&Ps are up 4. Taking a look at the Nasdaq here, if you take a look at the Nasdaq, and we'll look at the advanced decline line specifically in the Nasdaq, the advanced decline line in the Nasdaq, yes, it's positive, okay? But, again, the point being over here, yeah, the advanced decline line is positive, but it's by no means stellar, and the Nasdaq, of course, closed up almost a full percent. Again, up 52 handles over here, which is, again, drastic distortions that we're seeing over here. On the flip side, and I think this is also of critical importance, I don't know if anybody caught this, the Russell diverged, in fact, to the downside today. And I've been talking about this because the Russell, which has been just dead flat, is starting to channel a bit to the downside with really an increased volatility, and it's had some nice expansive ranges. So for those of you, you're trading on an intraday basis, okay, on an intraday basis, you better start looking at the Russell, because if you're looking at the Nasdaq, listen, the Nasdaq, you'd either get long or you can get long, right? You pretty much buy the Nasdaq and you're supposed to make money, right? Buy the dip, buy this, buy whatever you can. The Nasdaq, you're going to get it done. Inside of the Russell, we're actually getting some pretty wild and expansive ranges. Like this is trading. And when I say it's trading, like, this is a product that I'm now trading on an intraday level. And I hope that other traders, you know, tune in, turn on, and start looking at the Russell product a little bit more on a day-to-day basis. So yeah, again, you know, shoot me an email from time to time. It's just support@theotrade.com. Support@theotrade.com. Let us know, you guys trading the Russell at all? Because again, on an intraday basis, it's not a one-directional instrument. It's having reversals over here. And again, I'm finding on an intraday level, again, great success using the Russell. Now, let's flip the conversation a little bit over to bonds. Bonds throughout the course of the week, they're exploding back to the upside. Now, for those of you that have been following us quite a bit, we had a bullish trade on, and we didn't take it in the bonds. We took it in the TLT. The TLT is the ETF for the bonds. We have now exited that trade. So the trade only had a few days left to expiration. The trade expires next week, okay? And the trade that we actually had on specifically was this, and I'll delete this out here. It was the 123 half, okay? 125 half. Now, we initially bought this spread for about $1. We exited. A lot of people got out $1.35 and higher. You can see that the trade right now is about $1.59. So a lot of you had anywhere between a 35% gain up to about a 60% gain, depending upon when, of course, you exited your TLT spread. So again, I'm looking for more opportunities in the bonds. This has been a, again, big change, of course, in the bond product, which brings me to my next point. I'm going to go back to the ZB. So one of the things that we've seen lately is bonds ultimately selling off, right? So the bonds sell off. Great. What's that been doing? Well, bonds selling off, if we take a look at the TNX, okay, takes interest rates substantially higher. And we've seen from all the way, this is the 10-year, okay, this is the yield associated with the 10-year. And here it's actually moved from about 2%, almost just shy of 2.5%, and it's backed off. The reason I'm talking about, you know, the interest rate component of the 10-year, the yield, is simply because it influences the financials. All right. The financials exploded to the upside the moment those interest rates started taking off to the upside. So that move occurred from the 2% to 2.5%. Okay. That move is right here inside of the financials. I mean, the XLF moved from 24, shot all the way up to about 26. The part that a lot of traders have to shake their head at this point, you've just seen a reverse in the bonds. The bonds, okay, in the last, about week and a half of trade are now ripping to the upside. So now that we've got the bonds ripping back to the upside, interest rates now are backing off. Wouldn't you think that that would cause the financials to sell off? And yet they're not, okay? And this one begs the question, what ultimately is holding the financials together? And I think we could make some, arguments. All right, so people are going to see Jerome Powell is coming into the Fed. He's very pro-banks because he worked for one. He's an investment banker back in the day. I think you can make a lot of arguments along there, but this is really a simple idea. If the bonds continue to rally, it's going to snap the financials a bit lower. And that's a trade that I would look for this very next week. It was only a little over a week ago, I actually did one of these evening discussions that said the bonds are going to shape the next move of the S&Ps. And still absolutely firmly, okay, am behind that statement. But the bonds did started to make the move, and they have not snapped the back yet of the financials. And my thinking is it's actually the ZB getting above 154. Okay. And again, mark it on your chart if that does it for you. But the ZB right in and around that 154, and it's right here. Okay. We're there. And literally, if the ZB breaks a bit higher anywhere into this territory, I think that eventually is what's going to snap the financials a little bit lower. And in the short duration, that's one of the only headwinds that the marketplace seems to be even, concerned about. Obviously, news, jobs numbers, okay, FOMC. Again, Apple's earnings meant more than the FOMC. And I'm not just talking about the FOMC report that came out. The Fed comes out, they don't do anything. All right. I always compare the Fed to Punxsutawney Phil, which is, of course, the groundhog. 6 more weeks of winter, which means they're not going to raise interest rates for another 6 weeks. We'll have to see how Jerome Powell plays out starting in February, the next groundhog. All right. So last but not least, okay, looking at a comparison chart. And this is the final thought that I want to leave you with over here is the divergence just continues to grow. And if you're unfamiliar with what I'm actually discussing, again, kind of a parting thought over here, it's the divergence amongst, and this comparison over here, kind of label everything. On the top of your screen is the Qs, okay? Right in the smack in the middle of your screen over here is the SPY, okay? And last but not least, in the very bottom of the screen is the IWM, okay? Better known as the Russell. So this is comparison of the ETFs. And in taking a look at this, I'll even put a year-to-date percentage on here. When I say things like, the divergence kind of continues, the Russell is now officially diverging lower. Obviously, the Nasdaq continues higher, and the S&Ps are tracking a little bit higher. But at this point in time, looking back at this last week of trade, the S&Ps are only tracking higher because they're also weighted to Amazon and Apple. Okay, right now, the Russell is one of the only products that just isn't being influenced by tech kind of mania over here. Again, I can't, help but to reiterate my caution in this marketplace. Constantly within our chat room, and we're hundreds and hundreds of people a day through the TheoTrade chat room, and one of the tones that I continually hear that I think is, again, very alarming to me. I'll leave you with this thought, but a lot of people are saying, I'll get out of the marketplace when it looks like it's starting to finally turn. So effectively, they're playing chicken with the marketplace. Now, you could say this in a stock like Apple. So let's assume that somebody is just long Apple, and you'll get out of it when it starts to turn down. Now, that could be somebody in their 401k. That could be somebody in their IRA. These aren't even necessarily traders. Okay, and the reason I find that alarming is, okay, you have to recognize that at this point in the game. All right, let's look at Apple, for example. At this point in the game, Apple could drop 20%, and it would only take it back to levels, okay, from like midsummer. And I think we're past the point of the marketplace is not going to roll out a red carpet for you. It's not going to have big whirly flashing symbols, or a Bollinger Band, or, a magical Fibonacci that's going to tell you when to get out. Okay. At this point in time, you realize you have, all right, trillions of dollars of market cap, and you're one bad day away from very serious implications to the overall marketplace. Okay. If your strategy is I'll use a stop order, or if your strategy is I'll just get out when things start to look like they're going to turn, I think you're going to, have a rude awakening when the market does eventually turn. Prediction of markets is an impossibility. But the one thing you can see, and I think that we all agree on, is you've kind of gone too far, too fast. But you can keep going like this, all right? And it literally is a marketplace going 120 miles an hour, okay? When it's going to hit the wall, you don't know. So prediction of that risk becomes relatively easy. The onset and timing it is impossible. Thanks, everybody, for joining us at TheoTrade. Have a wonderful weekend. Bye-bye.